Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Wealth Services with our third quarter market review and outlook. Despite some typical September sluggishness in the equity markets, highlighted by the S&P 500 experiencing its worst month since March 2020, the third quarter was a modestly positive period for large cap stocks in the U.S. Inflation fears prompted an increase in longer-term interest rates, but upwardly revised earnings estimates supported stock prices in the period. Rising COVID cases and the ongoing debate in Congress over government funding, infrastructure spending, and the debt ceiling did increase economic uncertainty in the quarter, which caused small cap stocks, the asset class most sensitive to changes in the economy, to underperform large cap stocks. Also, emerging market stocks fell during the third quarter as the Chinese government began to tighten regulations on many of their most successful companies. This action, directed in important fields such as technology, culture, and education, caused investors to sell Chinese stocks aggressively. Additionally, China's second largest property developer expressed concerns over its ability to meet its debt service obligations, casting more doubt on China's economic recovery, as real estate represents 29% of the Chinese economy and could serve as a negative contagion if the company defaults. Because Chinese stocks make up about a third of emerging market indexes, their poor performance dragged the overall index results down. At McKinley Carter, we lowered our allocation to emerging markets and Chinese stocks in mid-August to reflect our discomfort in the trends we were seeing in China. As we look into the fourth quarter, three significant issues face the economy and the stock and bond markets. First, COVID cases may be peaking in some parts of the U.S. and the world, but variants still represent a threat to economies as colder weather drives more inside activity. However, we are heartened by the continued rollout of vaccines across the country and globally. As more people are vaccinated and/or infected, we move closer to the herd immunity levels needed to dramatically slow the progress of the disease. In addition, several therapeutics have been shown to be quite effective in treating many COVID patients. As COVID becomes less of a worry for individuals and businesses, as it did during the early days of summer before the Delta variant was so pronounced, economic activity will likely pick up, and corporate earnings in the stock market should reflect the positive change. Second, on a year-over-year basis, inflation data is running well above the Federal Reserve's 2% long-term target, and if left unchecked, could lead to ongoing higher costs for goods and services. While the Fed believes many of these costs are temporary spikes reflecting the year-over-year comparisons with pandemic lows and the associated short-term supply chain bottlenecks, any further indications of rising inflation would likely lead to higher interest rates and roil both the stock and bond markets. However, if inflationary pressures ease next year due to supply chain bottlenecks abating and the ongoing deflationary benefits of cost-saving technologies, long-term interest rates may remain range-bound, and the Fed may delay any increases in short-term rates. These would be positive developments for the stock market. Recently, long-term rates have moved up a bit as investors process the Fed's communications regarding their intentions to begin tapering their monthly bond purchases later this year due to an improving economic picture. We favor a slight overweight to stocks and an underweight to bonds, as even a gradual increase in long-term rates will negatively impact bond prices. This is why we lowered the interest rate sensitivity of our bond portfolios in mid-August by selling longer duration bonds. In addition, bonds are more expensive than stocks when considering their low yields compared to the current stock valuations that are supported by robust corporate earnings and positive seasonal trends for the equity markets. Also, despite the ongoing economic issues in China, we have confidence in the opportunities found in international stock markets as they currently trade at historically low valuations to the U.S. markets and should rebound as countries receive more vaccinations and move to fully reopen their economies. The third issue relates to the ongoing debate in Congress over the two infrastructure bills and the legislation needed to raise the federal debt ceiling. The infrastructure bills have far-reaching implications for the economy, the markets, and tax policy. Should the bipartisan traditional infrastructure bill pass, it would be stimulative to the economy, as we could begin the long-overdue work to repair roads, bridges, and other hard infrastructure. The other infrastructure bill, covering a wide variety of issues including Medicare expansion, universal pre-K, and climate change measures, comes with a potential cost of $3.5 trillion and would likely result in higher taxes for more affluent Americans as well as corporations. In sum, though passage of the bill in their current form is certainly not assured, it's important to review the lessons of history regarding market reactions to tax increases. Fortunately, history shows us that the stock market has mostly risen during periods of higher taxes on individuals and corporations, as well as higher capital gains taxes. Thanks for listening today. If you'd like to read more about how we view the previous and upcoming quarters, please be sure to read my full market comments in our quarterly huddle newsletter. Till next time.